We are back with David Burrows. Next up, we have a question out of Orillia, Ontario. Here is Early. Good afternoon.
Hi, Mark. Thanks for taking my call.
You're welcome.
Yesterday on your station, there was an interview with the boss of CN, and it was, for me, there was a lot of insight there. However, he did say one thing that I don't know if it's right or not, and I want to ask David because I do respect his opinion. He said that he's expecting next year's EPS to double. Is he just self-promoting, or does he have numbers to back that up?
Okay.
I would hope so.
Well, I think that they're not promotional at all. CNR have very, very strong shareholder relations. They've done a very good job of giving transparency to the street over time, and they do carry a lot of weight. As a company, CNR is one that we really like. We own it. I considered using it as a top pick today. I didn't have space for an extra one. CNR, I think, is a great investment at this time for a few reasons. First of all, they have a lot of north-south exposure, so you're really focusing on North America, Canada, US, and Mexico. They are a big beneficiary of improvement in the auto sector, which certainly is well documented, but there was a time when forest products were 25% of their traffic, and certainly forest products are looking more interesting. Lumber market's improving if you believe in a US home building recovery, which is slowly and steadily going on. They benefit there as well. They're very shareholder friendly. They're very willing to return capital to shareholders by way of share buybacks, and dividend increases. Dividend increases, by the way, across the board continue to look very positive going forward over the next year, and certainly those companies that do that are getting good valuations. Earnings per share should accelerate over the next couple of years, and so we think that the valuation that investors are willing to pay is going to continue to expand. It's not inexpensive, but it's a really well-run railway, and I think their operating ratio could get better, meaning they they continue to bring their costs down.
All right, thumbs up on CNR. We got an email from Noel on that company as well. Hope that answers your question. Patricia's in Toronto, who's next up here with a question on George Weston. Go ahead, Patricia.
Yes, good afternoon, Mark, David. Thanks for taking my call. My question is on George Weston. I'm not sure if consumer staples is part of your growth themes for 2014. But if it is, would George Weston be a good pick, or is there a better company in the staple space? Thank you.
Patricia, I think right now we want to be a little bit careful with things that are levered, their revenues are levered to food prices. Certainly we are seeing, falling inflation in food prices, if not some disinflation. So for instance, the grocery store chains have a hard time with revenues when prices are coming down. It helps them to contract. So that is an issue. The consumer staples as a whole are seen to be a more defensive sector, and that sector does well when uncertainty is high. In a time when things look like they're getting a little better, then people tend to rotate away to sectors that are a little more economically sensitive. So as it stands today, we have virtually no exposure to consumer staples. Not to say that they're not good companies, but again, you got to find good businesses, but then you have to build portfolios that are constructed out of sectors and themes that people care about right now. And I think that you're seeing more money leave consumer staples for other sectors than enter. So I would stay away right now, not to say it's not a great business, it's just not the right time.
Thank you, Patricia, for that question. We'll take another break here, and we'll come right back with David Burrows. Stay tuned.